Michael Price's avatar. He's currently helping clients manage their GSA and VA contracts, and he reads every comment. Welcome, I'm Michael Price, your host.
Today is June 22nd, and I'm Nancy, your co-host.
Imagine you're skydiving, right? And suddenly your main parachute fails.
Oh, man.
Yeah, you're in a terrifying free fall. The panic is instantly setting in. You reach for your emergency reserve chute, but there's a little tag attached to the ripcord, and it says, "To open, please successfully complete a 3-month trial."
Right. Which, that sounds like an absolute nightmare. In a moment of total crisis, when you're falling fast and the ground is just rushing up to meet you, the absolute last thing you expect or want to deal with is a test.
Exactly.
You just want the safety mechanism to deploy immediately so you can breathe again.
You just want to pull the cord and stop the fall.
Yeah.
But, when we transition from skydiving to the complex world of personal finance, specifically, keeping a roof over your head when everything in your life is going wrong, that is exactly the kind of counterintuitive, highly structured safety net we are looking at today.
It really is.
Welcome to this deep dive. Whether you are a veteran yourself or you're considering a VA loan for the future, or maybe you just want to be that vital resource for a friend or a family member who might be quietly struggling, our mission today is very clear.
Yeah, we've got a lot to cover.
We do. We are going to decode the brand new VA partial claim program, which officially rolled out on the 15th of June, 2026. And we're going to outline exactly how to use this massive financial safety net to avoid foreclosure.
And it is a fascinating, deeply layered topic to get a sense of where this actually came from. We're pulling from a couple of great sources today. We've got a set of detailed research notes from June 22nd, 2026, and a really insightful transcript from the Veterans InfoTap YouTube channel.
Both really solid breakdowns.
Definitely. And just to set the historical stage here, purely looking at the facts from the sources, we have to look back to the VA Home Loan Reform Act that was signed into law by President Trump on July 30th, 2025.
Right, so about a year ago.
Exactly. That legislation laid the groundwork. And now, with this official rollout, VA Secretary Doug Collins has made it very clear what the core intent is here. The goal is to help thousands of veterans who are facing severe financial struggles avoid foreclosure and, stay in their homes. That's the foundational framework we are operating within today.
Okay, let's unpack this. Because to truly understand how this financial benefit actually works for you or, a veteran in fetch, we first have to look at who holds the keys to access it.
Yeah, that's step one.
And I was genuinely surprised to learn that it does not start with the Department of Veterans Affairs. If I'm a veteran in trouble, my first instinct is just to call the VA.
Right, and that is the most common misconception. And honestly, it's a dangerous one because it can cost you valuable time. The primary identifier for this program, like the entity that actually initiates the whole process, is not the VA, it's your mortgage servicer.
The servicer. Okay, so let's define that for a second. We are talking about the company you actually write your monthly check to, right? Like the company whose name is plastered on the portal where you log in to pay your mortgage.
Precisely. To even be considered for the VA partial claim program, a veteran must already be in default on their mortgage, meaning, they've missed payments.
Right.
But the VA isn't sitting there monitoring your individual checking account. It's the mortgage servicer who sees the missed payments, flags the account, and then identifies the veteran as someone who potentially qualifies for this specific intervention. The servicer acts as the gatekeeper for the entire effort.
It makes me think of the servicer as like a bouncer at an incredibly exclusive club.
That's a good way to look at it.
Yeah, like the VA might own the club. They might be fully funding the club, but you still had to convince the bouncer at the door, your servicer, to actually let you in. And if you do manage to get past the bouncer, that is when you hit that ripcord test we talked about with the parachute analogy. The servicer places the veteran on a mandatory 3-month trial payment plan.
Right, the trial.
And I have to be honest, I really struggle with this step. If a veteran is already underwater financially, say they've lost a job, they had a major medical emergency, and they're already in default, why put them through the intense psychological stress of a strict 3-month trial just to get the help they desperately need? It kind of feels cruel.
Well, this raises an important question, and the answer gets to the very core of what this specific tool is designed to do versus, what it is not designed to do.
Okay.
The trial is not intended to be a punishment or like a hurdle just for the sake of bureaucracy. It is a strict assessment of future viability. The program is explicitly built to help those who can maintain their standard current payments moving forward once that heavy, suffocating burden of their past due balances is finally lifted off their shoulders.
I hear that, but it still feels like you're asking someone who's drowning to tread water for 3 months before you finally decide to throw them the life preserver.
I completely understand that perspective. But think about it from a systemic level, right? The VA and the servicer are trying to determine if the crisis was temporary or permanent.
Ah, okay.
So if a veteran lost their job 6 months ago, went into default, but hey, they just got a new job last week, they now have income again, they can afford their normal monthly payment now, but they absolutely cannot afford that massive pile of missed payments that accumulated while they were unemployed.
Yeah, the backlog.
Right. So the trial proves to the servicer, look, I am back on my feet. If you can just clear the backlog, I am good to go.
Okay, I see the distinction now. It's about proving you can sustain the normal baseline, assuming the acute crisis is handled.
Exactly. It's designed to save homes permanently, not merely to delay an inevitable foreclosure by a few agonizing months. If a veteran's income has permanently dropped and they cannot even afford the normal monthly payment during the trial, then wiping out the past due balance won't actually save the home.
Because they'll just default again in month 4.
Precisely. They'll just fall right back behind. So if a veteran fails to make those standard payments during the 3-month trial, the servicer will not trigger the assistance. You have to pass the crucible to prove the partial claim is actually the right tool for your specific situation.
That does reframe it for me. It's essentially a filter to ensure they aren't using a wrench when they really need a hammer. Now, assuming you do pass that 3-month trial, the program executes a very specific and honestly almost counterintuitive movement of money to wipe out your arrearage, which is just the industry term for that terrifying pile of past due bills sitting on your kitchen counter.
Yes, the mechanism of the payout is highly orchestrated, and it's important to note right off the bat that there is no strict maximum dollar amount specified for this program.
Oh, really?
Yeah, it doesn't cap at 10 grand or 50 grand. It is simply designed to cover whatever the overdue amount is that's required to make the veteran fully current again. So that includes missed principal, interest, taxes, and insurance.
Okay, let's use $20,000 as a recurring example, just for easy numbers today.
Sure.
So you owe 20,000 inches past due payments. Here's where it gets really interesting, because the money follows what I can only describe as a bouncing ball. And let me see if I have this right.
Let's hear it.
You complete your 3 months. First, your mortgage servicer pays the $20,000 overdue amount to themselves to bring your loan current. Then the servicer turns around, sends an invoice for 20 grand to the VA, and the VA pays the servicer back that same $20,000.
That is the flow, yes.
I'm looking at this loop. The servicers are essentially paying themselves just to turn around and bill the government, and it sounds like a Wall Street shell game. I mean, why doesn't the VA just cut a $20,000 check directly to the veteran so they can pay their own mortgage?
What's fascinating here is the underlying structural logic of that bouncing ball. It might look like a shell game on paper, but it's actually a brilliant way to eliminate risk and administrative friction.
How so?
Think about the danger of injecting a massive lump sum of liquid cash directly into the hands of someone who is in acute financial distress.
You mean like the temptation to use it for something else, like buying a car or something?
Not even just temptation. It could be intercepted by other aggressive creditors.
Oh, wow.
Right. If you have a $20,000 VA check, have a bank account that has a massive overdraft, or maybe a lien from a credit card company, that money vanishes before it ever reaches the mortgage servicer.
Oh, I hadn't even thought of that.
Yeah, by having the servicer pay themselves first, the veteran's account is brought current instantly, right at the end of the trial. The default pressure is immediately removed from the veteran's shoulders without forcing them to personally receive, handle, and correctly route a massive wire transfer.
That makes total sense. So this completely insulates the home saving funds from any other financial chaos happening in the veteran's life? It just bypasses the checking account entirely?
Precisely, and on the institutional side, the servicer acts as the intermediary because they already hold the loan and they manage the escrow accounts. They front the money internally to clear the books, and then the VA reimburses them.
Gotcha.
This mechanism instantly restores liquidity to the servicer's balance sheet, meaning they aren't taking a loss while keeping the veteran safely in the home. It's a closed loop. The institutions settle the ledger behind the scenes, and the veteran just wakes up the next day with a current mortgage.
I have to admit, that is incredibly efficient.
It is.
The immediate crisis is solved, the ledger is settled, and you are officially current on your mortgage. But, and this is a massive but for anyone listening, that $20,000 did not just vanish into thin air.
No, it certainly didn't.
The mechanism that saved the home today actually creates a very real obligation for tomorrow.
And this is the crucial trade-off of the VA partial claim program. Everyone needs to understand this. The money provided by the VA to clear your arrears is not a grant, it's not a gift, it is a deferred payment.
Deferred, meaning you do not have to pay it out of pocket right now, but the piper will eventually come calling. You have to repay the VA when one of three very specific events occurs, right? So the loan is paid off completely, the mortgage is refinanced, or the property is sold.
That is exactly correct. The servicer places what is essentially a silent second lien on the property, keeping a permanent record of that outstanding amount. Let's walk through a specific mathematical example from the sources to make this really concrete. Imagine you owe $300,000 on your house. Over the years, your home has appreciated nicely, and it's currently worth $500,000 on the open market.
Nice.
You hit that financial rough patch, you go into default, and the VA steps in through this partial claim program to cover a $20,000 arrearage for you. You pass the trial, the bouncing ball happens, you are current.
Everything is great.
Everything is great. Fast forward 5 years, you decide you want to refinance your home to get a better interest rate.
Right, you go to the closing table to sign the new paperwork.
Exactly. But because of that deferred payment, your new payoff balance when you go to refinance won't just be the $300,000 you originally owed on the main mortgage. The title company is going to pull the records, they'll see the partial claim, and your payoff balance becomes $320,000.
Okay, I see.
That extra 20 grand is added to the total payoff amount to ensure the VA is fully reimbursed out of the proceeds of your new loan.
It is essentially like placing a financial bookmark at the very end of your mortgage story. You're basically telling the bank, hey, skip this chapter of debt for now, but remind me about it on the final page.
That's a great way to put it.
But let me push back on this a bit because it sounds a little precarious. Does this mean veterans are essentially borrowing against their own future equity just to survive a present-day crisis? Because, if housing prices drop, that could trap them.
If we connect this to the bigger picture, that is exactly the philosophy of deferred repayment. And while it does carry risk, it's actually a highly pragmatic approach to home retention.
How so?
This system aggressively prioritizes immediate housing security over immediate debt settling. By pushing that $20,000 to the very back of the line, the program allows the veteran to use the naturally appreciating value of their home, their growing equity, to act as a massive shock absorber.
So you are utilizing the strength of the asset to literally save the asset.
That's exactly it. You are deferring the debt to a future date when presumably you are either selling a much more valuable home and can pay it out of the profits, or you're refinancing from a position of renewed financial strength.
Right.
It prevents the system from forcing you to come up with 20 grand in cash when you are at your absolute most vulnerable. Yes, it eats into your future equity, but you still have a home to build equity in. If they foreclose, your equity goes to zero immediately.
That is a stark but very real way to frame it. You give up a slice of the future pie to make sure you still have a kitchen today.
Exactly.
But what happens if that framework just does not fit? Because this entire program relies heavily on passing that strict 3-month trial, and it assumes you have the ability to resume your normal payments.
Right, which isn't always the case.
Exactly. So that could be a perfect fit for everyone. If you fail the trial, or if you look at the math and realize you simply cannot handle your old monthly payment anymore, what happens next? Does the servicer just initiate foreclosure? Are you out of luck?
Absolutely not. The safety net has safety nets underneath it. The VA partial claim is just one single option in a much larger, highly sophisticated toolkit.
Okay, that's a relief.
To give you an idea of the sheer scale we are talking about here,
Yeah.
the Department of Veterans Affairs worked with mortgage servicers to help 173,000 veterans avoid foreclosure in fiscal year 2025 alone.
173,000 inches a single year. That is staggering.
It's massive.
It really puts into perspective how common these struggles are.
It does. It removes the stigma. And if the partial claim is not the right fit, or if a veteran fails the trial, there's a whole category of alternative home retention options.
What do those look like?
These include traditional repayment plans, where, if you're only slightly behind, you just pay a little extra each month to catch up. They also include traditional VA loan modifications, disaster modifications, if you were hit by a hurricane or a wildfire, and specific 30-year or 40-year loan modifications.
So what does this all mean? If you're sitting down at the kitchen table looking at your budget and you realize your income has permanently dropped, maybe you had to take a lower paying job, might something like a 4-0 year loan modification actually be a better roadmap than a partial claim?
That is the exact kind of critical thinking required here. Let's break down how a 40-year modification actually works, because it is mechanically very different from a partial claim.
Okay,
A partial claim leaves your monthly payment exactly the same. It just pays off the past due balance. A 40-year modification takes whatever you owe right now, rolls the past due amount into the main balance, and then stretches that entire massive number out over 480 months instead of the standard 360 months,
which mathematically drops the required monthly payment.
significantly. By stretching the principal over an extra 10 years, your monthly burden drops permanently. For someone whose baseline income has permanently changed, this is a lifesaver. They can stay in the home with a payment that fits their new lower income.
That sounds great, but there's a catch, right?
There is. The trade-off is that by extending the loan by a decade, you are going to pay tens of thousands of dollars more in interest over the life of the loan.
Right. The bank is giving you breathing room every month, but they are charging you a premium in interest over the long haul to do it. It's a totally different strategy. The partial claim assumes your income is fine, you just tripped over a temporary hurdle. The 4-0-year mod assumes your baseline has fundamentally shifted.
Which is exactly why the mortgage servicer is designated as the primary identifier. They have to look at your specific income numbers, your debt-to-income ratio, and your arrearage to see which net catches you best without trapping you.
But we also know that dealing with massive financial institutions can be absolutely maddening.
Oh, without a doubt.
You're calling an 800 number. You're getting a different representative every single time, and trying to explain the worst period of your life to a stranger reading off a screen. What if you are butting heads with your mortgage servicer?
It happens all the time.
What if they're dragging their feet on the paperwork, or you feel they aren't offering you the right options, or they deny you for a trial and you just don't understand why? The advice we have here from the sources is incredibly actionable. Do not give up and do not just accept a no from a low-level phone rep. You need to call the VA directly.
Yes, absolutely. If you're hitting a wall with your servicer, you actually have a direct lifeline. You can reach the VA directly at 877-827-3702 and you select option 6.
Option 6.
Right, that bypasses the servicer entirely and puts you in touch with the VA's dedicated home loan experts who can intervene on your behalf.
If you're listening, pull out your phone right now and write this down. Even if you don't need it, you might know someone who does. 877-827-3702. Option 6.
It's a crucial number to have.
And beyond just calling the VA to complain about a servicer, there's a heavy emphasis in our sources on the critical importance of consulting an independent specialist. You hear names thrown around in veteran circles. People like David Peck, who was mentioned in the TAP specialists who dedicate their time to helping veterans build a personalized game plan. And that concept of a game plan is so vital. You shouldn't be wandering in the dark trying to decipher banking jargon when your family's home is literally on the line.
Yeah.
You need someone who knows the terrain.
Because there truly is no one-size-fits-all solution here.
Yeah.
The sheer complexity of these programs, from navigating the psychology of those 3-month trials, to understanding the delayed impact of deferred payments, to weighing the massive long-term interest costs of 40-year extensions, it requires a guide.
Definitely.
A specialist helps you look at your current immediate crisis, your future equity projections, and your long-term retirement goals to choose the right path before you ever sign a legally binding new agreement with your servicer.
To wrap up our conversation today, the absolute biggest takeaway is that knowledge of these benefits is your best defense. It's a sad reality that many veterans only learn about these retention options when the foreclosure process has already started.
And by then, it's often too late to stop the train.
Exactly.
Yeah.
But by understanding how the 3-month trial phase acts as a strict gatekeeper, how the bouncing ball of a payout clears the ledger without crushing you with cash management risks, and how the deferred repayment acts as a financial bookmark, you are now equipped.
You really are.
You have the knowledge to be a powerful resource for yourself or for a fellow veteran who might be too proud to ask for help. Remember that lifeline, 877-827-3702, option 6.
And as we close out, I just want to leave you with a final thought to mull over.
Let's hear it.
Think about this. Since its inception, the VA has helped veterans, service members, and surviving spouses purchase over 29 million homes.
Wow. 29 million.
29 million. And they do this by offering zero down payment requirements and competitively low interest rates, essentially taking on a massive amount of upfront risk just to get veterans in the door. So if the government is willing to take on that kind of institutional risk on the front end to turn veterans into homeowners, what does the intricate, deeply layered structure of safety nets like the partial claim program tell us about the immense societal and economic value of keeping them in those homes at all costs?
That is a great point. It tells us that the investment doesn't end at the front door. Keeping a veteran house stabilizes families, it stabilizes neighborhoods and the broader economy. And, just like that parachute we talked about at the very start, sometimes the emergency ripcord comes with a set of complex instructions, and sometimes you have to pull a few administrative strings to get it to deploy properly.
Very true.
But the most important thing is knowing that the reserve chute is packed, it is absolutely there, and now you know exactly how to use it. Thanks for joining us on this deep dive.
If you found this video helpful, please consider donating to helpallvets.org. Thank you.
A special thank you to MarketUS.com for furnishing us this information. You can reach them at MarketUS.com or call them at 954-636-3232. Before we go, this deep dive was created by the MarketUS.com team. Let us know your thoughts in the comments below. It's right below the subscribe link.